you stop and you say to yourself, there's something really wrong here.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
What's up, guys? Jay Martin here, CEO of Cambridge House. And this week, I wanted to share this conversation that I had with Danielle DiMartino Booth, who is somebody I've been wanting to talk to for a very long time. So I hope you enjoy this. Danielle is the founder of Quill Intelligence. She is a veteran on Wall Street, and she also spent 9 years working at the Federal Reserve Bank in Dallas. So I wanted to ask her point blank what happens behind closed doors at the Fed during crises like this, and we talked about that. I also got her opinion on any businesses and industries that she feels are forever changed as a result of this crisis, and where investment opportunities may arise in that scenario. As always, I asked her to open up about her portfolio and tell us where she's allocating capital in order to grow and protect her wealth. That's what this show is all about. So if you enjoyed this video, and I hope you do, please click subscribe. And in the comments, you can always let me know who you want to hear from next, and I will hunt them down. And if you want to hear from me more often, I publish a weekly newsletter to about 35,000 subscribers, and I would love to have you join us. Right beneath this video, there's a pinned comment where you can do just that. And I write about the lessons, advice, and anecdotes that I take away from conversations like this and plenty more. I hope you enjoy. Danielle, it's fantastic to have you here. I'm super excited to chat to you. And I know my audience is looking forward to catching this interview because you've really been all over the map in terms of where you've been positioned. You've been with some of the biggest firms on Wall Street. You've been at the Fed. Now you're doing your own thing. And, you know, we just chatted about this, but this must give you an edge inside what's going on in the brain of Jerome Powell.
Well, you know, I respect it, Jay. When he was on the board, he started with one of my favorite board members ever that's saying something for me named Jeremy Stein. Jeremy Stein has remained an outspoken detractor for a lot of what Fed policy has created, the monster that's created in the credit markets. But he and Jeremy Stein joined at the same time in June 2012. Obama nominated one Republican and one Democrat because he really wanted to get the one Democrat on the board, and that's often how things happen in Washington.
Right.
But Powell came on. He initially called out quantitative easing. He said that it was inflating a credit bubble across. He said that it was inflating a duration bubble across the entire credit spectrum. He called quantitative easing habit forming. He understood how it was working its way through the financial system. He came from private equity. That was his background.
Yeah.
He spoke to people in the hedge fund industry. When he was at the Carlyle, he founded the Industrials Group. So he spoke to CEOs and CFOs across America. He understood what Fed policy did in terms of financializing, engineering your balance sheet. So there was definitely a lot of mutual respect. When Richard Fisher retired in 2015, I followed him right out. I just had my 5-year anniversary, of leaving the Fed. In June of 2015, I ran into him in the fall and he said, look, I want you to pay attention to one guy, and that's Jay Powell. He's got his eyes focused on shrinking that balance sheet. He wants to get out of the reinvestment business. He wants for the Fed to go back to just the simplicity of raising and lowering interest rates and getting out of this whole unconventional monetary policy era. And I'm like, I'll follow him closely. He's my man. So when his name came up to be chair of the Fed, you know, I thought this was just going to be the greatest thing since Paul Volcker entered the building.
Okay.
And his first day in office, literally, the Dow Jones closed down more than 1,000 points. Janet Yellen would have put out emergency SOS, 911, DEFCON 1, whatever. Ben Bernanke, Alan Greenspan, they all would have reacted. He did nothing. He said nothing. His first congressional testimony, he was very resolute. It's not the Fed's job to back the stock market. I promptly founded the Jay Powell fan club on Twitter, very publicly. And then he found out how big the beast was. And that's when he realized that that the credit markets were bigger than he was. The days that followed General Electric getting downgraded, Halloween of 2018, and that prompted his pivot just a few months later, at which point I had to disband the fan club.
Now, do you think anybody could have made a different choice? Because he was so vocally opposed to that strategy that he's now implementing. It's easy to say, oh, I wouldn't do that, right? But we're not in his shoes.
is there, what creates that pivot? Is it the strategy was put in place in 2008? There's too much inertia. It's just too tough to change course. What happens?
Well, debt has become endemic, and it's not just in the biggest publicly traded companies that the Fed is now buying if they've been downgraded, if they're fallen angels. It's in small and medium-sized enterprises. It's in the private debt market. It's all over the pension system. So it's the whole idea of systemic risk being unleashed. That was what got to him after there was no junk bond issuance for 41 record days beginning November the 14th, 2018. The world authorities, they started raising the red flags saying, wait a minute, we've got spreads blowing out in the high yield market. And there's mass redemptions in these exchange traded funds. And the collateral backing them is trading by appointment only. So you've got a potential systemic situation on your hands, and something that's systemic is by definition uncontrollable by monetary policy. So that is when the Fed's obligation to uphold financial stability comes into play. So he felt that he had to get out there and say which is exactly what he did in January 2019. He said, I apologize basically for my naivete all those years ago when I denounced QE, at which point I said, that's it, I'm calling the divorce attorney. So, but you're right. In his defense, don't get me wrong, he's pushed it so far, he would make Mario Draghi blush at a cocktail party. He's pushed it that far. But when you're in a position like that and you're being told that you're going to blow up a bunch of retirees' lives and blow up the U.S. public pension system, they're clearly difficult choices that had to be made.
Right. Yeah. Now, so it's June 15th today. I'm hesitant to even talk about the market because if we don't publish this for even 5 days, who knows what's going to happen.
That's right.
But it's crazy what's going on out there. And we have hit new highs in the S&P. The Dow was up 47% or something crazy. And you've got people like Warren Buffett and Stanley Druckenmiller saying, we massively misjudged this recovery and we were underinvested. Does this have legs? Like, what's your take, Danielle, on call it the near term here in the equities market?
Well, what we're witnessing in the markets today is it's don't fight the Fed on steroids. You have an entire generation of index investors who've been told that it is not economical to pursue active management, that there's nothing that a human being can add in terms of value. Just let the machines take over and step aside, because don't fight the Fed. The Fed's always going to have your back. You may as well not pay managers to bring their brilliance in when all you have to do is own the index fund. Now, blow that up to retail traders.
Yeah.
Bring in a pandemic. Give millennials an extra $600 a week. Tell sports gamblers that they need to just stand down and go, maybe start gardening. So you've got a lot of high risk people now who are in the market. They're day traders, but they're day traders. I mean, they make the New York City taxi cab drivers from 1999 look like choir boys. They give a whole new meaning to day trading. They're doing it with options. They're doing it with leverage, and they're doing it in such massive numbers that they're able to move the markets. And they're doing it alongside major institutions as well, so that are going along for this ride. So this is, when you wake up in the morning and you hear that Hertz, a bankrupt company, is going to be issuing stock, you stop and you say to yourself, there's something really wrong here. When you know from living in Dallas, Texas, that even if American Airlines travel does come back to a certain extent, the business traveler is not coming back for anytime soon. American Airlines still has more debt on their balance sheet, and yet they've rented up, they've doubled it. So you have people on Twitter saying, these morons who have been in investing all their careers don't understand that all they have to do is be there. They just simply have to present themselves, and then it's going to go up. And that's the end of the story. Once you expand this to millions and millions and millions, between 50 and 70 million is the estimate right now of small investors, micro trading, it gets to be a movement in and of itself.
Right. Now, I can't imagine that that's sustainable. I feel like 9 out of 10 traders that I know don't stick with it. And in my experience, traders are super loud when they're winning and very, very quiet when they're not. Do you think this has legs as well? Can this continue?
Look, there's, I get a lot of pushback when I tell people that yes, it can, because bubbles don't have logic. They don't have reasoning to them. I mean, we've got a second outbreak in Beijing, and we know that China underreports the data. So,
Right.
whatever they're saying is happening in Beijing, it's got to be a lot worse. And you've got the open West. You've got all these states reopening and nobody wearing masks in the United States. And you've got more circumspect consumers than you've ever had. It's as if reopening hasn't happened for quite a few Americans. And at last check, the economy still depends on consumption, but you've got quite a few Americans who are not consuming the way that they did. So on a fundamental level, this reopening V-shaped recovery is a myth. It's not working. We've gone from 31.1 million Americans collecting some form of unemployment insurance, plus what happened with the CARES Act, emergency measures. We've gone from 31.1 million to 29.5 million. Wow. I mean, that's just great progress. The fact is we still have a ton of Americans, about 18% of Americans collecting unemployment insurance in some form that is not being reflected in the markets in any way.
Right. Okay. Now, there's a couple of things that I want to jump into. And let's start with the pandemic, I suppose, just because I don't know if there could have been a more expeditious test to find out if we've flattened the curve. We went from pretty aggressive social distancing to essentially shoulder to shoulder protests in every major city in North America. And in a matter of weeks, we're going to know, you think, about how real the potential of a second wave is.
Well, we're already seeing it. We're seeing it here in Texas. There were a bunch of high school seniors who had major parties. And so there's this outbreak among high school seniors because they were all in confined areas. We're seeing it 2 weeks after the Memorial Day holiday. So we're already seeing what the protests are going to look like. The only thing on the protest side is that they were in outdoor arenas, outdoor venues. But you throw a little bit of tear gas in for good measure and you got coughing. So we won't know until we know. But what we can say is that in 22 states right now, you've got a 7-day moving average that's north of what it was prior. And you've got states like Texas, Florida, Arizona, Utah. They're all coming up pretty fast. And here and in many places, masks have become so politicized that people won't wear them, even if it means that the economic reopening is going to be stronger. So it's completely counterintuitive. You cannot wrap your head around it if you try. It's like, if everybody wears masks, we can have something much more much closer to a U-shaped recovery.
Right.
If people don't wear masks, we're just going to go one step forward, one step back. So make your choice.
Sure. Yeah. Now, what's your take? Because there was a lot of debate about, where was the greater potential harm in letting the pandemic run its course freely or shutting down the economy and dealing with that human cost.
Right.
It's equally terrifying. And I think it was, I believe a good friend of yours, Barry Ritholtz, was discussing, I think it was Sweden. They essentially had the laissez-faire attitude. They let the pandemic run its course, but the economy was still hit just as hard because you can't escape a global economic shutdown no matter what you do independently.
And they've had their case counts come up in Sweden.
Right.
So that adds the insult to the injury. Look, there are places that have done this right. Carrie Lam famously came out right when the pandemic news hit the headlines. She came out and told the people of Hong Kong, don't wear masks, don't bother. People of Hong Kong came together and said, well, we know she's not our friend. So it was a pure grassroots effort in Hong Kong that everybody got together. They got the masks. They knew to protect themselves, and they've had 1, 2, 3, 4 deaths. That's it. That's it. They never closed everything down. They didn't shut. Now they're totally scarred by having SARS rip its way through their economy. So they had a test run, if you will, and they knew what the implications were. But there has not been economic devastation. Germany is reopening pretty successfully, which is easy enough to do if there's a 10,000 euro fine if you're caught not wearing a mask. So either you comply or you don't. But if you feel strongly that masks are not efficacious, that's fine. You get to pay. a lot of money. So all I'm saying is there was no reason to not reopen the US economy, but it had to have been done in a thoughtful, well-planned, coordinated fashion, despite the fact that we have obviously a federal state type system. For the greater good of the US economy, if you want it for it to come roaring back, you just needed to have a few simple guidelines.
Right. Okay. Now, I'd be curious to know, your thoughts on the big picture effects of the pandemic, meaning, what has changed in our life that probably will not come back. I think 80% of businesses in the US were deemed non-essential, so they had to shut down, which is a large percentage to say 80% of the economy is non-essential. What's from your perspective, Danielle, what's going to change or what has changed that won't change back? What's different now?
I think there are going to be two lasting impacts of this pandemic. One is going to be cultural, that will affect the economy. And another is going to affect the economy much more directly. I'll get to it first. Small businesses have grown for years using cheap labor. It's been something that's feasible because there's been a big enough pool of labor out there that will work for very little money in the United States. Small businesses are not going to do that anymore, to the same extent at least. They have now discovered that there's a cost to having too much human interaction, and that if they can find a way to automate, they will find a way to automate. Okay. And that, I think, is going to change how labor itself is viewed, because it's not just the largest companies or the biggest manufacturers that are automating. It's going to trickle all the way down to medium and small businesses who are going to place a premium on not having human interaction. And that is going to change the way businesses of all sizes in America operate and how they approach operating their businesses. So the McKinsey study that came out last year that said 33% of all US employees would eventually lose their positions to automation. The coronavirus has effectively expedited that movement. It's pushed it forward. Separately, most Americans, most generations of Americans have been told that they need to save for a rainy day. And it's kind of trite. It's cliche. You know, okay, right, I got it, save for a rainy day. It's never been tested, ever, until now. And now it's been tested and it's really hurt. And it's not just hurt, well, let me say it differently. It's hurt the middle, the core of the country. At the lowest end, you have people making $600 additional a week in unemployment insurance. They're making, in some cases, 1 out of every 5 people who are unemployed are making double what they made before. It's a good situation for the people at one end of the barbell, if you will.
Okay.
And the wealthiest are not affected because they're wealthy. It's the people in the middle, the people who make $75,000, $100,000 a year. They didn't qualify for stimulus. We know that the vast majority of Americans, even those who have not lost their jobs, have definitely taken a hit to their income. So it's this segment of the American population that is going to be affected, because it's no longer just okay to say you have to save for a rainy day. It's visceral. It's something that they know in their bones because they've experienced it and they've experienced the hardship. So again, this is not going to be across the board. I'm not trying to say that all Americans are going to wake up tomorrow and say, we're savers. But a lot of people in the middle who've been hurt by this will be savers. And we still have not seen the second wave of layoffs that we know is building in professional services, finance, real estate type positions that are going to be a result of demand destruction. We haven't even seen the true destruction that we will see in upper income, white collar paying jobs in America. That's building, that's coming. Deloitte and Touche, they announced they're letting 5% of their workforce go. We're seeing these headlines pop out every day. So there will just be a change in the way Americans view money.
No, I'm super curious about what you think some of those new habits might be. Would it just be keeping cash and that's enough? Do you think people will start looking towards asset classes, like the middle class maybe might start looking towards things like gold, Bitcoin? I know you're a huge fan of Bitcoin.
There will be, the move towards saving is, first of all, you're going to see it manifest in what and how people consume. I can't tell you how many people have come on Twitter and said, I've given up mani-pedis. I'm not shopping as much as I used to before. I don't go out to eat as much. I've discovered the love of cooking. You're going to see it. I'm not going to need to upgrade my car every 5 minutes. I don't necessarily need the most expensive. I don't have to live on the edge, which a lot of American families have been doing for a generation. But they're going to find out that saving's not so much fun in this wonderful world of zero interest rates, because they're not going to make anything on the money that they're saving. So you're right. They're going to look to alternatives. In the event that I'm right, that this is not going to be a V-shaped recovery and it's going to be a long, ugly slog and we're going to be in recession for some time to come, that people will start to look for the safety of precious metals. It's simply human nature. And there's a total fallacy. We ran the correlations at Quill last week. There's a total fallacy that it's some great protector of the dollar's buying capacity, because gold has done almost as well in deflationary times, as long as you've got enough of a disruption going through the economy. It is the ultimate shelter from the storm. And I think that a lot of people are going to have a better appreciation for that, because what they do have, they're going to want to have retain its value.
Right. Yeah, I love hearing that, because I think if you can find a silver lining in this crisis, it's that people maybe realize their fragility, right? And act differently moving forward, right? Which is really the best possible outcome, is that we
were founded as a country that invested today to save today to invest tomorrow. I mean, that's kind of, it will make our founding fathers happy, as opposed to saying we can borrow our way to prosperity.
Right. Okay, so let's follow that thought then for anybody who is looking to make some changes. Danielle, can you talk about your portfolio a little bit? How are you protecting your wealth right now?
So, it always helps to be able to recognize brilliance in others and be humble about it. So we've always had direct investments in startup companies. They haven't always worked, but again, if you have identified a serial entrepreneur who's close inside of your circle, seed them. That's something that we have done throughout the years. I have a robust portfolio of municipal bonds. Just because you throw out Illinois, you throw out the baby with the bathwater, which actually really used to happen in the olden ages. The babies always got washed last. So there was always a chance that the baby would be so murky, the water be so murky, you'd throw the baby out. Anyways.
It always sounded backwards to me. Why would they wash the baby last?
I know, it seems like that's the most vulnerable, but anyways. But there's something to be said for, okay, so Illinois is a train wreck, and maybe New Jersey, and maybe, CalPERS is leveraging up its portfolio in private equity. There are some known knowns in the municipal space. By the same token, there are some really well-run states and municipalities throughout the country that have proven to be money good and a nice tax shelter. So, but on a personal level, I will say that I don't own any funds at all. I have a good manager who picks out individual bonds, and that's definitely the more economical way of going about it, if you can.
Right.
And then we've got holdings in precious metals as well. But no, I'm not short the stock market, and I'm not long the stock market. I'm just nowhere near the stock market right now.
Okay, right. So you're not even neutral. You're just hands off.
Right now with the stock market, I'm hands off. Every single indicator, any indicator evaluation, any indicator of earnings, they're all haywire right now. They're all off the charts. Nothing makes sense. 40% of the S&P 500 can't even tell us what their earnings are going to be like 12 months from now. There's zero visibility. The E and the PE ratio is undefined. So I'm like, okay, move on. I'm not that smart. And it's not that I'm, again, short the market either, because that's potentially even worse when you've got these unknown forces that are pushing stocks around.
Yeah, absolutely. Okay, now when you're looking at investing or seeding a startup entrepreneur, are there certain industries right now that seem more appealing to you? Emerging sectors?
Well, I think I think the move towards making everything that used to be, and this is going to sound so antiquated, but the fact is it's going everywhere. It's spreading. It's wonderful. It's looking at companies that streamline anything that used to be on paper. It's being able to conceive what a house blueprint looks like and put it on an app on your phone so that you know what to do 1 year from, 5 years from now. I need to go, there's a hole in the wall and I need to get the paint. Well, you just go, this room, this paint color, reorder, boom, done, end of story. Everything's being automated. Things that used to be in files, they're being automated. Doctors will continue to come to you. If this coronavirus, I heard an epidemiologist being interviewed who said that your average coronavirus, once it's infected 60% of the population, it kind of vanishes into thin air. And by the way, we're at 5%. And I went, oh my gosh, what if he's even half right about that? So if this is going to be something we learn to live with, then we're going to be consuming a hell of a lot more healthcare in our homes. So there are major disruptive factors that are going to emanate from this corona crisis that are going to change the way the consumption that we do consume is done. And there are going to be a lot of winners that come out of this.
Awesome. Yeah. One that I'm looking at specifically right now is telemedicine. There's been some really exciting stories, and not just for the upside, but as a consumer, I think I would probably get far more advice, or I would see a doctor far more often if it were that easy, right? But when you have to call in, book an appointment 2 weeks down the road, and then it's massively inconvenient and archaic.
Oh, it's a process. I have 4 children. It is a process. Trying to get 4 teeth cleanings at the same time on the same day usually requires 30 minutes on the phone with the person scheduling.
Of course it does, right? Huh. Okay, so when you're talking about precious metals, are you buying the bullion, Danielle? Are you buying coins and bars or equities? All the above?
Actually, just ETF here. I'm fairly novice. I got in about 9 months ago. Yep. And I'm just, and I own a silver fund as well. I've got a great friend in the industry who follows this very closely. So rather than make my own choices, I just said, what are you in? And he told me, and that's how I got in it. Because it was a lot easier for me to find an expert, somebody who did it all day long and on Sundays, and just say, how do I do this the most efficaciously, the most economically, hit go. And there, it was done. And I'm pleased.
I'm very curious who your friend is.
My friend is Peter Bookfar.
Ah, very cool. All right. Yeah. I was talking to him 2 weeks ago.
Yes. He's been following metals for a very long time now.
Very cool. Very cool.
We're very close friends.
Got it. And so do you anticipate precious? So you're just buying ETFs. You're not buying physical bullion at all?
Not at the moment. No, I'm not getting fancy. But I will tell you though, that a good friend of mine, Christopher Cole, who's at Artemis Capital, he's kind of the king of volatility. He understands it better than anybody on the planet. He's written a seminal paper that was published a few months ago that basically says, because we're coming into a massive shift in the way we conceive portfolios, one of the first ones in 80 years, his advice is that you can't be wimpy about precious metals. You have to understand that it needs to be a big 25% of your portfolio. It's not just that little 10% on the edge, just in case. That at times when you're seeing entire economies and an entire long market cycles shift, you have to be very bold in your exposure to precious metals. And I think Chris is very wise to say that, because people look at it as being in a really small silo. And I think that that's the wrong approach.
Interesting. Yeah. Okay. I tend to agree. Now, when you think about your portfolio, do you compartmentalize into, call it like long-term insurance, dividend or yield-paying investment, and then speculative buckets as well? Or how do you allocate?
Well, I mean, I look at precious metals as something that's going to be ever present, because I think that we're in this for a long haul, as I was saying. As far as income generating, that's where my municipals come in, and they do a really bang up job of it. The price moves I don't even pay attention to them, but I know that they're throwing a certain amount of money off, and that's all I need to know. My mother, bless her heart, she's 72 years old. I've got her in a Ginnie Mae ETF with a fee that's so small you can barely see it. She's pleased. She makes more than inflation. She makes way more than she can make in her savings account, and it just takes care of her in her retirement years. So I try not to get too tricky unless it's these startup companies, in which case there's your speculation all day long, because you're betting on a flyer, on the brilliance of somebody and how well they're going to be able to execute it.
Now, what do you have some set criteria when you're sitting down with a new entrepreneur, and Are there any consistent red flags that you see that as soon as you see, deals off, I'm out of here, or similarly, the right things that you're looking for?
So I think the word pro forma is a dirty word. So I look very closely at financials from the get-go. I was 9 hours shy of sitting for my CPA when I was in business school. So I think that you have to be very careful around assumptions. Okay. And if you're too aggressive and everything, you're like, wow, you're going to grow the company that quickly and by that much? Bye-bye. So I think the more conservative that individuals are, not with the idea, but with how quickly they can grow it out. And because that dictates how lean they're going to run the company from the get-go. And I like to see a company run by people who are not sleeping and who are extremely lean, and they've got a good startup mentality, and you've got people working 24/7 and they don't want to bring overhead in. That's what you want to see. Conservative financials, really hardworking people.
Roger. Okay. Now, US dollar. Are you bullish on the US dollar relative to other currencies for 2020?
So I get that the Fed is printing all this money. I get it. But so is the Bank of Japan, and so is the European Central Bank, and so is the Bank of England, which is flirted with negative interest rates. So 3 of my 4 kids take Mandarin, and it's with good reason. Because it's my long-term insurance plan is that if for some reason there's a hot war one day, because I don't think a Cold War would do it, because there's not enough acceptance of the yuan for it to take over the US dollar in terms of its reserve currency status. Okay. But if there was a hot war one day, there's a possibility that the dollar could lose its reserve currency status, at which point I would want all of my children, even though the middle one in the middle child, the black sheep, he backed out a few years ago. But three out of the 4 is great, that they would possibly be able to live in a world that was more China-centric. Yeah. And that would be reflected in the currency. We're not there yet, and China's not there yet. So China's got
forgive me,
way more debt. Sorry?
I'm not familiar with the term hot war.
That's guns.
That's a literal war. Okay.
That's a literal war.
I made that assumption, but wanted to clarify. Okay.
And that is truly how all reserve currencies historically, going back to Portugal, Spain, that's how they lose their status. It was that's how British pound sterling lost its status.
Right. Okay. So 2020, you don't see, despite the fundamental challenges with the US dollar, will remain the world's reserve currency for the foreseeable future. Do you see that game ending?
Again, if it ends, it's going to end in a way that's going to have all of our attention. And we'll have other problems on our hands other than the dollar. So it's not something that I'm not saying is impossible. It's just going to remain, as my boss, Richard Fisher, always said, when we were working together, it was the most attractive horse in the glue factory. It's going to keep that status, but it is still in a glue factory. So it's still headed to slaughter one day. I'm just saying it's the others are going to slaughter before. Okay.
Now we don't have to talk about Bitcoin, but I'm curious your thoughts just on digitized currency in general, sovereign nations moving to digitized currencies. Do you see something like this occurring?
I think that there is an inevitability for national security purposes when it comes to sovereign cryptocurrencies. I mean, once you saw the first 3 countries jump in, China, Russia, Venezuela, I mean, those were the first 3 entrants, and they're doing it more so that they can monitor what people are buying and find yet another way of monitoring them. But it was years ago that the Bank of England said that they were investigating. We know for a fact that the Federal Reserve is investigating FedCoin or whatever it might be called. I think that there is an inevitability globally for all major sovereign nations that they eventually are going to move onto a digitized platform of some kind. Hopefully quantum exists by then, so it's a lot less expensive. But I do think that it is something that shouldn't even be spoken of as a potential outcome, but as an inevitability. Okay.
A few rapid fire questions for you, Danielle. I want to put you on the spot and ask for the best advice you've ever received. What comes to mind?
The best advice I ever received was from the head of research at the Dallas Fed, who is my mentor, a gentleman by the name of Harvey Rosenblum. And he said that the worst thing that you can let happen to your career is that you're so right for so long that you're rigid in your thinking. If something changes in the big picture that needs to sway the way you're thinking. He hired me and couldn't stand me. He just, the things that I was writing about the housing market blowing up, and we originally did not have the best. He said he would read what I would write and throw it in the garbage can. But years later, he, by the same token, introduced my work and said that from now on, Danielle's work will go into everything that we do before it's taken to an FOMC meeting. We have to change the way we approach monetary policy making. And he was right. But I tell myself that you never get too married to a way of thinking.
Love that. Love that. Okay. Danielle, what is one news source that you cannot live without?
Twitter.
Twitter. Across the board every time. It's Twitter. Yeah.
Well, I mean, I limit myself to 500 follows. I only follow 500 people. So if I feel like, wow, I've discovered this great new personality, or if somebody I know debuts on Twitter, I have to go find somebody to delete. But it is my filter. So if I miss something in the Financial Times, or if I miss something in Barron's or in any publication, I'm not going to miss it. It's going to be on my feed.
Okay. Yes. And you're very active on Twitter. What's one book recommendation that everybody watching should read this year?
This will not be unfamiliar to anybody, but read The Lords of Finance.
Hey, excellent. Okay. I thought you were going to say Fed Up, but
oh, well, if you haven't read Fed Up, you're shame on you.
Yeah, right on. Okay. So why The Lords of Finance? Break that down for us just for a second.
Well, that's what brought me to the term hot war. And it goes through the establishment in 1913 of the Federal Reserve and kind of the downfall of major central banks in Europe, and kind of the group think that enveloped central banking, which it has now. It's a global phenomenon. Everybody's doing the wrong thing together. There are the parallels with 1913 on through World War I, and then the massive amount of debt that was created in the aftermath of the wars, and then the Great Depression that eventually followed. It showed a lot of the fallacies of central bankers at the time. It goes through the most beautiful discussion of gold that you'll ever see, best history ever written. But it's more so that when you put the book down, you'll be shivering because of the parallels between then and now. So there are serious lessons to be taken if you need to make sure your conviction about central bankers gone wild is correct. Read The Lords of Finance. Read Fed Up. Lords of Finance will take you a lot longer, by the way. Anyways.
Right. Okay. Yeah. Similar topic from Grant Williams, Raoul Paul, a handful others. Yeah. You know what? And I ordered it on Amazon in March, and it just has not arrived. Huh. Must be in high demand right now. Yeah. Okay. Danielle, I really appreciate your time. It's been awesome chatting with you, and thanks so much for coming on.
Likewise. Take care. Be safe.
Okay, that's a wrap. Thanks so much for watching. If you enjoyed this, please click subscribe, and then in the comments, let me know who you want to hear from next, and I'll go get them. Thanks.